You are watching Market Watch, the brief overview of the key events from the world of finance. On Wednesday, the Chinese stock market experienced a sharp decline, completing an impressive rally. The main reason was the disappointment of investors in the absence of promised stimulus measures from the government. The opportunity to calm the markets has been missed, and the stock market rally is likely not to be sustained until the authorities present a detailed stimulus plan. Volatility in the Chinese market has already put pressure on European companies. Later on Wednesday, the minutes of the US Federal Reserve September meeting are expected to be published, but analysts do not expect significant news, as Fed officials have been actively commenting on the positive impact of a strong labor market report on the economy in recent days. As for the foreign exchange market, there was a decline in the New Zealand dollar, which broke through its 200-day moving average after the Central Bank of New Zealand lowered interest rates by 50 basis points and hinted at the possibility of further cuts. This happened against the background of the fact that the markets are reducing their expectations for a reduction in interest rates in the United States. This factor puts additional pressure on the New Zealand currency, namely, on its exchange rate against the US dollar. Philip Jefferson, deputy chairman of the Federal Reserve, said on Tuesday that the 0.5% interest rate cut last month was aimed at maintaining a strong labor market despite the continued decline in inflation. Jefferson stressed that he would monitor incoming data, forecasts, and the balance of risks when considering further rate cuts. As the economy evolves, I will continue to update my policy vision to best promote maximum employment and price stability, Jefferson said. Meanwhile, in Europe, European Central Bank member Yanis Sternaras supports the idea of 2 interest rate cuts this year and predicts further easing in 2025 amid lower inflation. He said this in an interview published by the Financial Times on Wednesday. According to Sternaras, who heads the Central Bank of Greece, inflation could reach the 2% target in the first half of 2025, which creates the prerequisites for a faster reduction in excessively tight interest rates than previously thought. That's all I have. Follow the news carefully and be prepared for all the surprises of the market.